let's talk more about Nvidia's upcoming results. For that, we want to bring in Jeff Krumpelman. He is Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. I know you have been a fan of Nvidia in the past, so here we are ahead of the results tonight. Jeff, what is your view on Nvidia? Is it still a good buy?
Yeah, absolutely. Nvidia is just a beast. And, when you look at the progress that they've made, 100% plus revenue growth, 100% plus earnings per share growth, and they just have huge advantages over competition right now. It's so much more than just GPUs. It's, about parallel, processing and computing. And they've got not only the hardware and the chips, but also the software and just the ecosystem, the stack that puts them heads and shoulders above the competition. So we've owned it. I do think that it's become such a large position within the passive indices. We slightly under-own it relative to its representation in those indices. And I think it's a good thing, but we're going to continue to have significant exposure to it. You have 7 or 8% positions in a stock and you under-own it. That says something about, how well it's done. But yeah, expectations are high going into this quarter, but we think that the secular trends and demand for AI, generative AI is just there. Absolutely.
As we think about how software companies have really been judged by this rule of 40, really focusing in on their growth rate and ultimately how they're able to showcase to investors as well profitability and how they can get to that 40% marker. What about for chip companies? And is Nvidia setting a whole new standard, a whole new bar for what the rule that's applied to chip companies should look like, and what kind of growth should we see and expect a company like this to settle at, especially given some of the tough comps?
Well, that remains to be seen, right? And that's the concern, is that you've seen triple-digit level growth probably slowing. If you look at longer-term expectations, 2-3 years out, you see that slowing to 35 or 40%. But you have to kind of back up and say, okay, well, is valuation appropriate, high, cheap? Where does it fall? And it's trading at something like 36 times earnings, which gives you a price to earnings growth ratio of around 1. I think that is appropriate. And in terms of its ability to do what it's doing, first of all, the end markets are growing so strongly. But this is an innovative company that's continued to push on that front. And so 2-year cycles, what used to be 2-year cycles in introducing new chips is now condensed to 1-year cycles. And because of the software advantages that they have that are tied to this, I mean, you're looking at gross margins here that are 70%. Compare that to, an AMD, Intel type of gross margins, in the 50 to 60% range.
Jeff,
yeah.
Jeff, what happens if Nvidia misses tonight or disappoints? What should investors then do? Should they be buying the dip?
Well, we're dealing from a position of strength, and I would think that would be, of course, it depends upon the news they come out with, but I would think, based upon the knowledge that I have, it would be a buying opportunity. And there are a lot of people that have not owned the stock. We came into the stock in the pullback in 2022 when everybody was saying, oh, my goodness, you don't want to own these companies. Go away, move away from tech and growth, because the 10-year treasury might go from 3.5% to 4.5%. And, that was kind of a laughable argument when you think about 100% revenue growth, and that really is going to be trumped by 10-year yields rising 100 basis points. So I do think it would be an opportunity. This is a stock that was trading closer to $100 a share only a couple months ago, and it looked to move back towards a previous low in the upper 90s, and now we're at over 140. So I do think it would be a buying opportunity. That's how I would look at it.
Jeff Krumpelman, who's the Manor Wealth Advisors Chief Investment Strategist and Head of Equities. Great to have you here with us this morning.
Thank you. Appreciate it.